A market doesn't need to crash 50% to become a bear market. In fact, some of the biggest investing opportunities have emerged when fear was at its highest. A bear market happens when major stock indexes fall at least 20% from recent highs. But bear markets are about much more than a number. They usually occur when investors become concerned about the economy, corporate earnings, or future growth prospects. As uncertainty increases, confidence begins to decline across the market. During a bear market, investors often become more defensive. Volatility rises, risk appetite falls, and many investors shift money into assets they believe are safer, such as bonds, cash, or defensive sectors. Bear markets can be triggered by many different factors: economic recessions, rising interest rates, inflation concerns, financial stress, geopolitical conflicts, or unexpected global events can all contribute to market declines. As uncertainty grows, businesses may slow hiring, consumers may reduce spending, and investors often lower expectations for future earnings and growth. This can put pressure on stock prices, especially for companies with higher valuations or weaker profitability. But history teaches an important lesson. Bear markets have always been temporary. Markets move in cycles. Periods of growth are often followed by slowdowns, corrections, recoveries, and eventually new expansions. Some of the strongest long-term market gains in history began after periods of heavy fear and significant declines. That's why many long-term investors focus less on short-term market movements and more on maintaining discipline, patience, and a long-term strategy. Bear markets can create fear in the short term, but they also remind investors that markets move in cycles, not straight lines.